Residential brokers, by design, are creatures of optimism. Up market, down market, side market, they always find reasons to be cheerful. But the brokerages themselves that they hang their hats with, how are they faring in one of the most unpredictable markets in recent memory? Let's break it down by looking at how some of the public real estate brokerages are doing. So let's start with Douglas Elliman. The company, which went public at the end of last year, has seen its stock plummet 60% and reported profits of $10 million in the second quarter. In an earnings call, the company's chair, Howard Lorber, blamed the lack of supply for the company's sluggish sales, saying that though the spike in mortgage rates was a concern, it was less of a hit on the luxury market, where the overall story is more about financial volatility and uncertainty rather than mortgage rates themselves. Compass's overall losses have been massive. Since the beginning of 2021 through June of 2022, it has lost nearly $800 million, including $101 million in the second quarter. And its company narrative has pivoted from growth to attaining that elusive nirvana, profitability. The company's market cap is now at $1.1 billion. That's well under what they opened at $8 billion, and even under what they raised from VCs, which was $1.5 billion. Compass CEO Robert Redfin continues to emphasize its strong financial position. He also said that our critics will try to create confusion, so make of that what you will. Turning to Redfin, the discount brokerage's stock took the heaviest hits this year, down nearly 82%. Its second quarter losses were also substantial. It lost $78 million, and in June, it too laid off a chunk of its employees, about 8% of its workforce. CEO Glenn Kelman turned to wartime language to describe the market and the state of his company. This won't be enough to sink the battleship, he said. And finally, the biggest of them all, Realogy, Anywhere. The company's stock is down 48% so far this year, and it too announced an unspecified number of layoffs in August. It's a parent company to Sotheby's, Corcoran, and Coldwell Banker, and it plans to slash costs by nearly $70 million by the end of this year, and by more than $300 million through 2026. It did, however, manage to turn a profit, generating more than $88 million in net income in the second quarter, and it's making a big push to pay down its debt. It's now on the hook for $2.9 billion, most of it coming due at the end of the decade. So those are the spark notes on where the public residential brokerages stand. It's a good barometer for where the market might be going, but we'd love to get your comments. And be sure to follow The Real Deal for more residential breakdowns.